I'm going to use this example here to explain what a notice of interest is. So a notice of interest is a recorded document that basically points back to the contract for deed. And there's a very important reason for doing this as a buyer, and we're going to explain, and this is in the continuing education classes that we teach in this office here. This is born of several questions that have been asked to Jax Petty, who is the real estate attorney who teaches the class and put it together, and I just happen to teach my section of it on the lender stuff. But this is a great question that buyer's agents will ask. Well, what if my buyer puts a down payment down on the property, and after they have closed on the transaction, the seller has some issues that come up? What if the seller files bankruptcy? What if the seller has judgments? What if the seller has tax liens? These are all things that can affect the title to the home because the seller is still on the title. The buyer has a recorded notice of interest, but how does this all shake out in the courts? So, not an attorney, I do know 16 words of Latin, but I'm going to basically paraphrase what Jax has taught about this. And I'll get his thumbs up on the video before I actually publish it. So you'll know that if you're seeing this video, you'll know that what I'm telling you as far as Utah state law is concerned is accurate. So the buyer comes in, they have a $500,000 sales price, they put $50,000 down, and then they have a contract finance amount of $450,000. The seller is going to be getting $1,000 a month cash flow. In other words, the payment here that the buyer is making to the seller is $1,000 a month more than what the seller is making to his bank or the underlying senior note. So these are some acronyms on here: sales price, contract finance amount, underlying senior note. If you're reading a contract for deed, these are the terms that are in that contract, so that you can be familiar with them. So the seller still, if you look here, the seller still has $100,000 of what the seller is going to consider trapped equity. That they have equity in their home, but they can't really access it. Now there's ways to do that, but for right now we're just going to assume that the seller is content to get his $1,000 a month of cash flow off of the difference between the payment here and the payment there. What if the seller does run into some issues? Okay, so if the notice of interest is recorded, so we've got kind of, if you can sit and think about it, we've got a house here, okay, and pardon my artwork here, it's not going to be good, but we have got the first claim against the property that actually comes before the mortgage would be the taxing authority, the county or the city where the property sits. So you have, the first underlying lien position here is taxes, okay? I'm going to have to get another marker. Let's see here. So we've got taxes, okay? They have priority, okay? So that has to be paid first. But then after that, we would have the first mortgage, okay? It has a claim after that, and what happens when you close at a title company and get an owner's policy of title insurance, which goes back to the first mistake that some people make with seller finance, is that they'll just do a kitchen table closing with a contract for deed. There's no owner's policy of title insurance issue. Doesn't mean that the contract for deed terms are not valid, but you have some potential issues. So let's say that any prior issues that the seller had up to this point have all been cleared up now, okay? If those were mortgage arrears, unpaid property taxes, whatever. Anyway, this has all been cleaned up. So now the pecking order here is first claim here is taxes, then it's the mortgage, and then what we do as soon as we've closed on this transaction with a contract for deed, we have the notice of interest, okay, which comes into place. So that is a recorded document. And normally what it would do, it would just reference to just say that on this date, this party that owes this amount of money entered into a contract with the party who owes this amount of money, and we are recording their beneficial interest in this property, okay? So what does that really mean, and what happens if after the closing the seller gets in trouble. Let's just say that the seller doesn't pay their taxes for a couple of years and they get an IRS tax lien. Let's just say it's for 50 grand. Okay, so now all of a sudden the seller here has, $50,000 IRS lien. Okay, now the IRS is going to know that, well, this guy has equity in a house. Well, wow, look at that. He's got $100,000 of equity. He owes us $50,000. Let's go ahead and slap the lien on the house. And let's try to enforce it. Let's say that the IRS, in the absence of the seller finance contract, can actually, for their enforcement mechanism, they can, basically force the house to sell to be able to pay them. Okay? But what has to happen first is that anybody that got in on the equity of the home first has a prior claim. And that prior claim has priority over what the IRS lien is. Okay? So again, where does this IRS lien fall? Well, this one falls right here, and it's behind the taxes, behind the first mortgage, behind the notice of interest. The IRS can come in there. So they have this claim on this little sliver of $100,000 of equity in here. Well, what can they actually do? Can they record the lien against the house? Yep, they could. They could slap the lien on there and then they have a lien on the house. But what does it affect? Well, the seller finance buyer here, they have $50,000 of equity. It doesn't affect their equity. Let's just say they've been in the house for a couple of years. Maybe they've finished the basement, done some improvements, and the house is worth $600,000 now. If the house is worth $600,000, well, now the buyer, the seller finance buyer, also has $150,000 of equity in the home. So this $100,000 of trapped equity, the IRS cannot foreclose or force them to surrender the property. The only thing that the IRS has a claim on here is this, the cash flow. Okay? So if you've gotten an owner's policy of title insurance, which was number one thing that you got to do, the number two thing regarding the title of the house is to get a recorded notice of interest. And if you're closing your transactions with the right title company, this is just automatic. You don't have to sit and wonder, is it getting done? It gets done. But what that does is that prevents the seller finance buyer from forfeiting anything here, because the only thing the IRS can do, they're going to have to start hunting around for other assets to try to redeem that asset or to be able to foreclose on it, because all they can do here is grab the cash flow. So hopefully that makes sense and puts things at ease a little bit, but it's really important that buyers understand the power of closing out a title company, getting an owner's policy of title insurance from the seller, and then recording that notice of interest to protect the buyer's equity in that property and to also insure against any subsequent to the closing issues that the seller might get into. So thanks for coming into thecreditjungle.com today. This is George Anderson, and I would look forward to helping you structure your financing on any type of transaction for a home that we can get you home ownership and the terms that you deserve. Take care and have a great day.
George of the jungle, strong as he can be.